It is my immense pleasure and my honor to welcome all of you here, all the dignitaries who have come far away, especially to make this event a very successful.
At this time, I would like to now invite eminent speaker Dr. Thangjam Ravichandra Singh. Dr. Thangjam Ravichandra is a seasoned administrator and an incisive academician with more than a decade of extensive experience. Alongside his administrative role, he worked to set up an impressive environment to bridge the gap between corporate and business schools. His area of expertise lies in the leadership role, strategic plan, brand management, and investment avenues. Dr. Thangjam Ravichandra Singh is sharing his research on feasibility of Monte Carlo simulation for predicting equity prices in Indian stock market sectors. Welcome to the stage.
Good afternoon to all the participants here today. My name is Dr. Ravi, and I represent the university back there in India. We have worked on research for financial investment. So I come from investment strategies and also to do with the corporate finance and personal finance. I would like to give you a small presentation on how the strategy-based investment can be done. Definitely, I'm not going to go on to the mathematical models, but I'm going to talk about a simulation technique called as Monte Carlo simulation. Before we look into how the Monte Carlo simulation is used to simulate the equity share prices, let me give out some problem statement. Point number one that we will need to look at is how could an investor would like to invest their savings and not to incur any potential losses. That's the first question that we have to think about. The second point here is whenever we look into in terms of the industries, sectorial indices, if not as of the country's economy, we have understood one thing loud and clear, and that is whenever uncertainties hits, let it be recessionary or inflation measures comes in the picture, we have seen over the years, as the historical data also points out, that it is very difficult to look at the overall growth of a country. Now, looking at these two as my primary preface, I have looked into how an investor can be can definitely use this predictive simulation. I have looked into at least 85% accuracy to look at how equity share price can be predicted. With this, I have invested my own self, and I have got a list of clients who have come to me, and we are on a mission to create a lot of wealth and also to mitigate the risk. Mitigating the risk is the most important task in my research, and I have looped in Monte Carlo simulation. Now, to give you an introduction about the Monte Carlo simulation looked into from about 3,000 iteration. Now, in this 3,000 iteration, what we are trying to see here is, as it is a probability model, we are talking about the accuracy as one of the outcome through which I can achieve my objective. So first pointer is to look at how can I accurately predict the equity share prices. I have selected about 15 equity shares, 15 stocks based in India. And in the future, I'm going to go ahead with globalized in the form of about another 30 to 50 corporates, their equity share price to be predicted. At this moment, I have done research with about 15 corporates based in India. All of them are listed companies and they have been there for about minimum 25 years. That's my criteria. Number one, in terms of these 15 corporates, I have divided that into three different sectors. I'm looking at one from hospitality, I'm looking at from the other from the entertainment, and also the third is from the banking, the actual pillar of any economy, the banking sector. I've selected five from each of these sectoral, and these five, the total of 15, was selected based on the market cap. The market capitalization I looked into from small cap, from mid cap, and also large cap. So this 15 as of the sample, I'm trying to encompass, some kind of a generic statement that I can put forward, looking at all the three categories of the corporates that is based in India. Now, in terms of the feasibility study, as I've mentioned, a line about it where it's about 3,000 times we are going to repeat again and again, and it is done with our Excel macros, with the VBA uses, and through this, in about 3,000 iteration, I have come into a conclusion where we would be able to predict the equity share prices. I would like to focus what I have said before. It's about 85% accuracy. 85% itself is a very high accurate standard that we have seen in this financial domain. So in this 85%, what we are trying to say here is that if a company equity share price is about $100, and we would be able to look at in the next 30 days, in these upcoming 30 days, how much will be equity share prices may come up to. It may so happen the equity share price about $100 can become 105, can become 110, or if not, it can also go down based on the macroeconomic variables. Now, these macroeconomic variables are pretty large to combine all of it. So we have, again, filter some of the important key parameters and then come into the prediction. As of right now, if I can talk about as a conclusive remark, we are right now working on this particular model, and I've already achieved 85% accuracy. In about the future, maybe in a year or so, I'm going to encompass a country specific, let it be from UK, Canada, US, and I'm going to focus their corporations where if I can predict the equity share prices. I have done it well, and in terms of the investment, we have yield huge return, and also by mitigating the risk. So the risk has been put a cap, and we are talking about a higher probability that you would definitely end up on a higher return. So this is one thing that I would like to present to each one of you. If you have got a question, please feel free to ask me. Yes, thank you, please.
Yes, I've done everything possible in the stock market and can't figure it out.
Yes.
I've done the ups and the downs,
Definitely.
and doing my markup on the charts. So what can you offer, or are you going to be able to share your strategies?
Yes, right. Definitely. In India right now, I represent the country Bharat, India, and I personally have got about 300 plus client base through which I'm guiding them as an advisor. By qualification, I'm a PhD in finance, and also I have also looked into as the certified financial consultant from a US. So with my qualification, with my expertise, I have actually guided 300 plus clients there back in the country. Now, in terms of this model that I'm presenting here today at this conference held at the University of Oxford, is to look at how far I can make it large. I'm not looking at a smaller base. For me, 300 clients is a smaller base. So I'm going to expand. I'm going to look at, spreading my wings across the different parts of the world and to have these kind of strategies to put in place. So this is where I'm going to target in about a year or a year and a half. I am very positive. Well, it worked in one specific country. I may face some challenges in the upcoming, weeks and months to go by, but I'm ready to face those challenges. Look into how can I devise a global investment strategy. And in terms of what you have mentioned, that many of the investor definitely would have tried to look at, we call them as a floor price, we call them as a ceiling price, and then try to look at in terms of how much the bandwidth would it be. So I have used something called as Bollinger Band personally on my personal investment strategies. There's a method called as Bollinger Band, and then I've tried to put a standard deviation of 2 to look at how much the deviation, how much the volatility would be there in a particular stock. And then I look at the prediction at this moment, as per the historical data for the last 30 days, and as of right now, and in the future, how much the price variation would it be? Definitely, there are a lot of study which has been done. The literature done by various research scholars are enormous. There are volumes of literatures out there. One of the important highlight which I can talk about is something on technical analysis and fundamental analysis. Now, these are the two different studies that you have to do to ensure that the risk can be mitigated, and at least you would be able to earn a better return. Now, apart from these two, what I have come from is on common sense trading strategies. Common sense trading strategies talks about without looking at much of a risk, but you are going to look at a higher return. So your return will be more, but risk would be on a cap. This risk was not going to go up. So risk has been ignored, risk has been mitigated. Risk, we are putting a cap, but return would be on higher side. That's where I come from in terms of the investment strategies. And I've used this technique called as the Monte Carlo Simulation. If you have any other question, I'll be really happy to take it forward. Investment strategies is pretty complex by nature, but then I don't want to explain the mathematical model, so I thought I should give a talk instead of the research presentation, so that I've cut short on it, right? I hope all of you are clear.
One question from my side is with a lot of global, especially the pension funds coming to India, do you think that the country itself is poised for absorbing these funds? And one second, in terms of the returns, that is probably on the what they anticipate. Are we going to do some justice there?
Well, to answer this, let me give two different perspectives. Point number one that I can tell you is that there is no free lunches. So as there is no free lunch, you are looking at, let it be pension or provident fund or any other type of fund. It depends on you. It depends on your objective in terms of how much would you like to save for your future, and or if not, your investment strategies. That's point number one. No freelancers at all. So risk is there. You're going to talk about the investment, and you are going to incur those risks. Looking at those as a calculated risk, you're going to talk about it. The second perspective is based on your risk appetite. We have something on risk appetite. I am talking about a presentation today as a research findings. What I'm trying to talk about is for a niche group of people who do have a high risk appetite, meaning they don't want to invest in a mutual fund. They don't want to put their savings on a fixed or if not a time deposit. They're not looking for that. I personally come from a high risk appetite, so my investment would definitely go to equity or if not on derivative instruments. So that's where I come from. But in terms of answering to the question, in terms of pension fund or let it be the provident fund, these kind of investment comes under a risk category, which sometimes can be called as risk averse instruments. Risk averse instruments has got a very small risk associated with it in terms of liquidity or if not in terms of the default risk. So there's a small type of risk is involved in it, and I personally come from a high risk appetite where somebody would be willing to invest your own hard-earned savings into a high risky instrument without suffering the losses, without having the potential to go on losses, but still you're going to aim at a very high return. So this is where I come from, and I'm really happy to say it aloud to each one of you that I have been personally doing for the last 16 years in terms of the equity trading. And as of my own career to be mentioned, I'm a professor of finance, and I love to be in the market. Let it be here, let it be here in the UK, or if not back in India. I have done a lot of study, and then I come in front of you to give out this research finding.
Thank you for your presentation. It's very informative. So you mentioned that you work in the US and also India and now the UK. Do you see the similarities in the markets?
Well, in terms of the question that you are putting forward, let it be from India, let it be from US or UK. Now, the question of point of similarity is pretty much huge. Now, all of us, all the investors, they are hungry. They are hungry for putting a cap if there could be a model that we can create where risk can be mitigated, but still aim at the higher return. Now, this combination, this requirement of an investor's perception, where if I can put a risk on a cap and earn a higher return, that similarity across not only about these three countries that we are talking about, it's about the globalized net worth. Anyone across the globe would definitely aim at not incurring the potential losses, not ready to take up huge risk. So the point of similarity is definitely there. But in terms of the instruments, in terms of the financial instruments where the investment can be made, each country has got their own slightly tweak features in terms of how a UK or a US or India or any other country, including Japan, has got their own style here, has got their own uniqueness in their financial instruments. There, back in India, we are also talking about investment come insurance plan. In US, we are looking at the time deposits having slightly on a volatility. There, in terms of UK here, we are talking about time deposits plus insurance, plus someone would also look at some kind of a balance fund mutual. So this is where each country has got their own perception about it. But in terms of the point of similarity, I am 100% sure, and I can confidently tell you, all investors wants to have risk to be capped. So that's where the probability model has come into picture. And one of the probability models which I've used is Monte Carlo Simulation. Thank you, Professor.
Thank you.
Can I just ask a quick
Please.
one?
Yeah.
Good morning, thank you for your
Hi.
presentation. I just want to ask you regarding the global things that's going on right now in the economy regarding the low cost of living, the high cost of living, and a lot of poverty.
Sure.
How do you think going forward government can help those who are poor, those who are, you know what I'm saying?
Understood.
How do we get back up out of poverty, and into growth, and not just for individuals, but for
As a nation, for a country.
yeah, absolutely,
Right.
especially after the pandemic.
Sure. Irrespective of the current situation, let it be post, or if I can talk about the pre-COVID period, this question is slightly politically inclined, because if I have to talk about a particular country, I would not be looking at as an academician answering this, because when I look at from academic theory versus someone being a representative of the nation, of the people living into that country, where our perceptions differ. Like, this is an honest answer and a response to you. A politician would be definitely looking at in terms of the community engagement, to look at how the concerned people who come under the below poverty line, or someone who is in hardship, how would we be able to move them out? Academically, our perceptions are slightly different. Academically, we are trying to say that it's a very bold statement, but I would like to make on record. Whenever I say as an academician, we will need to control our population, we need to control our economic growth, we are going to have a very stricter norms. Like, when we are talking about any other foreign immigration to come in, it definitely impacts the country's economy, let it be on per capita income, or let it be from the economic progression. I do have got a lot of criticism on what I have just now said. One of them, which I also agree on, is that whenever we are looking at the immigration coming down, a lot of skill sets, a lot of important knowledge sharing, let it be technological based, or if not at the technical skill sets, has been also brought about, which can definitely improve the country's economy. Now, to answer that broad question that you have put forward to me in terms of how a government, how a country, how a nation can actually ensure that it is a collective growth. It's a mutually, we need to focus in terms of what kind, there are a few countries, including here in UK, the tax slab is pretty high. There are a few countries, including the GCC nation, where income tax, what we call as direct taxation, is not being charged at all. So in terms of looking at how a government's revenue can be generated versus the government expenses are pretty high. And that's where many of the countries suffer something called as fiscal deficit, where the revenue is less and expenses are more. If the government collects more taxes, or if not have got some kind of initiative where they can have more revenue for the government, then definitely the problem, the issue that we are talking about in terms of poverty, in terms of the equity to be spread across all the citizens of the country, that would have been solved. Right? Thank you.
Excellent, thank you. The next award goes to Dr. Thangjam Ravichandra.